Hi, my name is Billy Flowers and welcome to my channel where I talk about velocity banking and how we can use this strategy to massively pay off debt. So in today's scenario, we have another one with multiple credit cards. So we're going to see how we can pay this debt off. So let's get started. As always, our four key numbers. We're going to start with our income of $7,000. We have our expenses at $6,500. Our debt is at $40,000, and our cash flow currently sits at $500. Now, like I mentioned, we have multiple credit cards here, three in this case. We have credit card number one for $10,000 at $400 a month. Credit card number two at $15K at $600 a month. And the last credit card also at $15K at $600 a month. And all of these cards have a 25% interest rate. Now we do have some expenses here. We have our rent at $1,700 a month. We have a car payment at $500 a month, car insurance at $150 a month, and the rest of the bills that we can pay with a credit card equals $2,550. Now down here, I have the interest that would be calculated on the $10,000 credit card and the $15,000 credit card if we only paid the minimum monthly payment. For the 10K credit card, it'll equal $2,500 per year for the first year and $208 per month. For the 15K credit card, $3,750 per year and $312 per month. So we're going to see how we could wipe out all these credit cards starting off with $500 a month. So let's get going. So we're going to start with credit card number one for $10,000, and we're going to be putting in $3,450. Now, if you've been watching these videos for a little bit, you're probably already going to know how we came up with this number, but for the new people, sometimes this can get confusing. I'm going to show you how we came up with $3,450. Now, before, what we were going to be putting on our credit card was going to be $3,050. And what we had to keep in cash in our bank account to pay our rent, our car payment, our car insurance, and these credit card bills was $3,950. But since we're putting in $3,450 of income into this credit card, what about this $400 monthly payment on this credit card? What happens to it? Do we pay this $400 on top of what we're putting in the card? Of course not. So when we do this, when we put all this income into the credit card company is like, hey, man, you went way above and beyond putting money into this card. So this monthly payment right here is gone. This monthly payment no longer exists, right? So then what's that going to do? We're going to move over here. What I'm going to have to keep in cash now is going to go down $400 because this monthly payment on this credit card is no longer a bill. So we're going to subtract $400 from that. And now we only have to keep $3,540 in cash. And what we're going to put on the credit card is now going to go up $400. And now this is going to be $3,450. See how it matches? Also, our expenses are going to go down $400 because this credit card is no longer a bill. It's no longer an expense. So that's going to go down $400. It's going to bring our expenses down to $6,100. And what about that most important number, our cash flow? What are we going to do? We're going to get that cash flow, right? $400 of cash flow that we're getting. Plus $400 equals $900. You seeing that right? As soon as we put all of our income that we can put in, that we figured out, as soon as we put our income, start putting our income into the credit card, this monthly bill, remember this was a bill, now this turns into cash flow. And the only thing that we have to worry about now is paying the interest on the credit card every single month. So let's see how this is done. So like I said, we're going to put our income, our $34.50, into the credit card. It's going to bring the balance down to $6,550. And then our expenses, the rest of the bills that we've been charging on the credit card, is $2,550. That's going to raise the balance up to $9,100. Now, we're going to go back. We're going to remember the math that we learned in elementary school here. We started off with $10,000, and now after our income went in and the expenses that we run through the credit card comes out, it goes down to $9,100. Now, how much money is left out of that? Does it look familiar? This cash flow number? $900. That's our cash flow. And now we're going to have to pay our interest on our credit card. And what I like to always do is I take the interest off of the high starting balance of the month, knowing that it's never going to be this high, but I just like to put it there because you're going to beat these numbers on the board, and just to leave room for any kind of error or any kind of math mistakes that we make, or things happen in life. So the interest is going to be $208.33 in interest, raising a balance up to $9,308.33 at the end of month one. Now you look at that interest charge and you're gonna be like, wow, that's kind of high. Yeah, it is kind of high, but remember, you were used to paying $400 a month for this bill, for this credit card. Now you're just paying the interest on this card, which is $208, and that's even high. So our net cash flow is not $900 right now because you have to factor in the interest. So we're sitting around a little under $700 right now. Just a little under, because this is 208. So we're a little under $700 now in net cash flow, but it's still higher than the $500 that we started with. And each month, as we pay this debt down, we're going to get closer and closer to this $900. And I also want to make this clear. The expenses also includes all the monthly payments of these other credit cards as well. We're not stopping paying. We're not going to stop paying our expenses when we're paying this card. The $6,100 in expenses includes the bills that we have to pay with our credit card that we're using, this $2,500, plus the rent, plus the car payment, plus the car insurance, and plus these remaining two credit cards. I want to make that clear. We're not going to stop paying the other expenses just because we're working on this credit card. No, we're still paying the expenses. So in month two, we have our income of $34.50 going in. Our expenses of $25.50 is coming out of the card, raising the balance up to $8,408.33. Then we have interest now. It's under $200. That quick. $193.92, raising a balance up to $8,602.25 at the end of month two. Month three, we have our income going in, our expenses coming out. The interest we're getting charged now is $160.46. $7,862.71 is the balance at the end of month 3. Month 4, we have our income going in, our expenses coming out. $163.81 is the interest. $7,146.52 is the balance at the end of month 4. Month 5, income in, expenses out. $148.47 is the interest. $66,374.99 is the balance at the end of month 5. Month 6, same deal. Income in, expenses out. $132.81 is the interest. $5,607.80 is the balance at the end of month 6. Month 7, we have our income of $3,450 going in, lowering the balance down to $2,157.80. We have our expenses coming out of $2,550. Balance is going to be $4,707.80. Now the interest is $116.83, raising a balance to $4,824.63 at the end of month 7. Month 8, we have our income going in, our expenses coming out, $100.51 in interest, raising a balance up to $4,025.14 at the end of month 8. So right now, even though we're calculating the higher interest on the higher interest on a month, now we're at $100. So if we just minus $100 from $900, now we're at $800 net cash flow. We're getting there. So we have month 9. We have our income going in, our expenses coming out. $3,175.14 is the balance. $83.86 is the interest. Balance is going to be $3,209. Oh, that's it. $3,209 at the end of month 9. Now, since our balance is lower than what we've been putting in of the $3,450, you know me, I like to do our flip so you can actually see the balance go down a lot clearer when it goes down to 0, rather than me putting in the exact amount, or we're going to have a difference or any kind of negative numbers. It's easier to see the math this way, and it's less math, so that means it's less prone to mistakes. So we're going to have our expenses come out first, just on the board. You're still going to do the same thing. You're still going to be paying your bills the same way, but just on the board, I'm going to show the expenses coming out first of $2,550. It's going to raise the balance up to $5,759. Then we're going to have our income coming in of $3,450. That's going to lower the balance all the way down to $2,309. $66.85 is going to be charged in interest. $2,375.85 is the balance at the end of month 9. Month 10, we're going to have our expenses coming out, our income going in, lowering the balance all the way down to $1,475.85. Interest we're getting charged is $49.50. So now our net cash flow is like $850. See how close we get? Raising the balance up to $1,525.35. And I'm going to put month 10 here since I forgot to put it, just so you can have it for reference. Month 10 there. All right, so month 12, we're going to have our expenses come out first, right? We're going to have our income going in. Now, look at that balance. You see that? $625.35. Now look at that interest. $31.78, raising a balance up to 6,000. Oops, my bad. $657.13 at the end of month 12. Month 13. So we're at a year and 1 month now. We have our expenses coming out, right? Raising the balance up to $3,207.13. You know, this whole time we've been putting in $34.50. So as the bills come out throughout the month, you're just going to be paying them. It's going to be paying them until you pay off this exact amount. We're done. Month 13. 10K is gone. 1 year and 1 month. It's gone. This credit card now is free and clear. You have a zero balance. And what else is going to happen when you pay this credit card off? That almighty credit score. What do you think is going to happen to that credit score? And what do you think is going to happen to the credit limit on this card when this company sees how you paid this card off? What do you think they're going to do with your credit limit as well? Both of those numbers are going to go up, and that's what you want. You want your credit score to go up, and you want these credit card companies to give you more money to play with, because they figure if I'm going to give this person more money to play with, that means they're going to spend more. Well, we ain't going to be doing all that. We're just going to continue running our expenses through this card, paying it off in full every month, and we're going to be collecting those rewards, right? And speaking of the rewards, let's go over there right quick. At 1%, charging $25.50 every month. That's $25.50 every single month in rewards. So you're going to be deducting $25 off of every single month off of this card. And if we multiply that by 1 year, 12 months, it's $306 that we're offsetting on the interest cost. At 1.5, that raises to $38.25. Multiply that by 12, we're talking about $450. So what you think that's going to do with the interest that we're actually paying on the card? You think that's going to drive the percentage down or up? Factoring in the rewards as well. Ain't that crazy? And of course, we got to go back to school for a little bit. And we're going to see the actual interest that we actually got charged, the percentage-wise. Because remember, these are at 25%, all these credit cards. So I went up and added up all the interest that we paid, $1,457.13. And what you're going to do is you're going to go on Google. You're going to open up Google on your phone or laptop or PC, and you're going to type in $1,457.13 is what percent of what we started with, $10,000. Now I already did that on my phone on my end. So now, this is kind of simple math. We're just moving decimal points since it's a percent. So we get since it's $10,000, it makes it a lot easier. 14.57%. That's what you actually paid in interest when you did this strategy. This is what the credit card statement says. This is what they tell you that you're getting charged, but this is what you actually paid. That's not factoring in the credit card rewards. That's also not factoring in the actual percent that you're going to be paying the actual dollar amount that you're going to be paying every single month. Because remember, I did it off the high balance, off of every single month. And if you had a keen eye, you would even notice that I charge a little extra interest on one of these months. But I'll let you look at these numbers and see if you can find where I made my mistakes. See, I like, I know this is math, but I like the ones that are really paying attention to see where I made my little mistake at. And it just added a little bit to the actual total. It didn't, the numbers would have changed, but I just added a little bit of interest. So even this right here, you would have beat this even more. So this interest cost right here, it's a little bit higher than what it should be. Just a little bit, just a little smudge, not much. But I made a mistake. But I want y'all to see what month I made the mistake in. That's a little homework for you. But this is just part one of this scenario, because why? We got two more credit cards to pay off here. We got two credit cards, another $30,000 worth of credit to pay off. We got these two $15,000 credit cards charging $600 a month. These cash flow takers. I like to call these the cash flow takers, because that's all they do is take and take and take from your cash flow. And it it just it eats up your cash flow, and that's why you wonder why you're struggling every month, because you have these monthly payments that are just eating up or taking your cash flow every month. But you're going to have to stay tuned for part two, where I finish this scenario up. So I just want to thank you for watching, and don't forget to like, subscribe, and comment below. And like I always say, get that cash flow.